Welcome to Global Watch. Please subscribe and hit the bell icon for more breaking updates. In the intricate web of global finance, few events have the power to send shockwaves across continents quite like a sudden shift in the U.S. Treasury market. The U.S. Treasury market is often considered the backbone of the world's financial system, a safe haven for investors and governments alike. When tremors hit this foundation, the effects ripple far beyond Wall Street, touching every corner of the globe and impacting economies both large and small. At the heart of this unfolding drama is China, one of the largest foreign holders of U.S. debt. Recently, China has begun to reduce its U.S. Treasury holdings, a move that has sparked widespread concern and speculation. Some analysts warn that this could be the opening salvo in a new kind of economic warfare, where financial tools replace traditional weapons. The implications are vast, raising questions about trust, stability, and the future of international cooperation. This strategic shift by China casts a shadow over the stability of the global economy. The consequences are not limited to high-level policymakers or financial institutions. They trickle down to everyday people. Mortgage rates could rise, retirement funds may face new risks, and stock markets around the world could experience heightened volatility. The uncertainty is palpable as investors and ordinary citizens alike brace for potential aftershocks. The once symbiotic financial relationship between Washington and Beijing is now under immense strain, exacerbated by an ongoing trade war and growing mistrust. What was once a partnership built on mutual economic benefit has become a battleground for influence and leverage. Negotiations are tense, and every move is scrutinized for its potential to escalate or diffuse the situation. Beijing's accelerated selling of treasuries is widely interpreted as a calculated geopolitical maneuver designed to send a message to Washington and the world. This strategy is not without risks for China itself, but it signals a willingness to endure short-term pain for potential long-term gain in the global power balance. Tonight, we delve into the chaos unfolding in financial markets, examining the profound and far-reaching consequences of this seismic shift. As the world watches and waits, the stakes could not be higher. To truly grasp the current situation between China and the U.S. in the global debt market, we need to look beyond the headlines and understand the deep financial ties that have developed over decades. This relationship is not just about numbers on a balance sheet. It's about the intricate web of economic interests, trust, and sometimes rivalry that binds the world's two largest economies together. At the heart of this story lies the U.S.-China financial entanglement, a complex and evolving partnership that has shaped the modern global economy. For years, the United States has relied on foreign investment to fund its government debt, and China has been one of its most significant partners in this regard. As a global manufacturing powerhouse, China amassed enormous trade surpluses, earning vast amounts of U.S. dollars. Rather than letting those dollars sit idle, China invested heavily in U.S. Treasury securities, effectively lending money to the U.S. government and helping to keep American interest rates low. This created a unique codependency. China needed safe liquid assets to store its wealth, and the U.S. needed a reliable buyer for its ever-growing debt. Both sides benefited, but both also became vulnerable to each other's decisions and policies. At its peak, China's holdings of U.S. Treasuries soared to an astonishing $1.32 trillion, making it the largest foreign creditor to the United States. This position gave China significant leverage, but also exposed it to risks from U.S. policy changes and market volatility. In recent years, however, China has been actively diversifying its reserves. Instead of putting all its eggs in the U.S. dollar basket, China has increased its holdings of gold, euros, and other foreign assets, seeking to reduce its exposure to the American financial system. The share of dollar assets in China's reserves has dropped dramatically, from 79% in 2005 to just 55% by 2019. This shift reflects a broader strategy to protect China's wealth from potential shocks and to assert more independence in global finance. This diversification strategy accelerated as geopolitical tensions rose, especially with the growing threat of U.S. sanctions and trade restrictions. China's leaders have become increasingly wary of relying too heavily on a system that could be used against them in times of conflict. The recent sell-off of U.S. treasuries by China is not an isolated event, but rather the culmination of a long-term trend. The ongoing trade war, tit-for-tat tariffs, and political posturing have only intensified this move, turning what was once a quiet shift into a headline-grabbing development. What we're witnessing is a strategic pivot, a carefully calculated adjustment in China's approach to global finance, not a sudden or reckless move. It's about managing risk, asserting sovereignty, and preparing for an uncertain future. The financial dance that once brought the US and China closer together is now turning into a jarring separation, with profound implications for both countries and the world economy. Trade tensions between the US and China erupted in 2025, escalating into economic conflict. The US hiked tariffs on Chinese goods, seen as aggressive and punitive. China retaliated with its own tariffs, signaling readiness to endure economic pain. The financial arena became a new battleground, with China reducing US Treasury holdings. This move was seen as financial retaliation, weaponizing its economic power. The perception of China dumping US debt sent a destabilizing message to global investors. The tariff escalation and China's Treasury sales caused chaos in global markets. The US Treasury market, usually stable, became turbulent. Yields on 10-year Treasury notes spiked, signaling investor panic. The sell-off affected all US government debt, raising borrowing costs. This volatility spread to global equity markets, causing sharp declines. The interconnected nature of finance meant no market was immune. The sudden decline in bond values eroded confidence in US financial stability. The search for alternative safe havens intensified in a fractured world. The recent turmoil in the US Treasury market has dramatically raised the political stakes in the already complex relationship between the United States and China. What was once a contest over tariffs and trade imbalances has now evolved into a high-stakes struggle over the very foundations of global finance. China's actions in the Treasury market are increasingly viewed as a direct challenge to US economic sovereignty, sending shockwaves through financial and political circles alike. The scale and timing of these moves have left many in Washington questioning the security of America's financial future. The very idea that a foreign power could manipulate US borrowing costs is deeply alarming to policymakers. It raises uncomfortable questions about the vulnerabilities inherent in the global financial system and the extent to which America's economic power can be leveraged or undermined by others. As a result, diplomatic tensions are on the rise. Behind closed doors, back-channel talks are being sought in a desperate attempt to ease financial anxieties and prevent further escalation. Both sides understand that the stakes extend far beyond economics. For China, targeting the US Treasury market is more than a financial maneuver. It's a bold show of defiance. It signals Beijing's willingness to use its economic clout as a tool of statecraft and to push back against what it sees as US dominance. By taking these steps, China is signaling its intent to carve out a path that is independent of the US-led financial order. This move is not just about economics, it's about asserting national pride and strategic autonomy on the world stage. The escalation between these two economic giants has profound global implications. It is testing the strength of existing alliances, forcing countries to reconsider their loyalties, and eroding long-standing norms of economic cooperation that have underpinned global growth for decades. The weaponization of finance, using markets and money as instruments of power, sets a dangerous precedent. It blurs the line between economic policy and national security, making every financial decision a potential act of geopolitical aggression. As a result, financial markets are no longer just arenas for investment and trade. They have become battlegrounds where nations compete for influence and control. Volatility and uncertainty now ripple across the globe, with every diplomatic misstep or policy announcement. The stability and predictability that once defined global trade and investment are now under threat. Businesses and investors must navigate a world where political tensions can disrupt markets overnight and where the rules of engagement are constantly shifting. This conflict is accelerating the trend toward a multipolar world, where economic power is distributed among several centers, rather than dominated by a single superpower. New alliances are forming, and emerging economies are seizing opportunities to assert themselves. Around the world, nations are carefully navigating between the interests of the US and China, weighing the risks and rewards of aligning with one side or the other. The choices they make now will shape the future of international relations. The financial battlefield is reshaping not only markets, but also the very institutions that govern global affairs. International organizations and alliances are being tested as never before, and the rules of the game are being rewritten in real time. The stakes could not be higher. The outcome of this confrontation will have profound implications for the future of the global economy, for the balance of power among nations, and for the lives of billions of people. As the world watches, the balance of financial power is shifting before our eyes. Every headline, every market move, is a signal of deeper changes underway. The outcome of this financial standoff will shape the global economic landscape for decades to come, determining not just who leads, but how the world's nations interact, trade, and prosper in the years ahead. The Treasury market turmoil raises U.S. borrowing costs. Higher yields make government auctions more expensive, impacting taxpayers. Rising Treasury yields affect interest rates on mortgages, loans, and credit cards. This squeezes household budgets and dampens consumer spending. Businesses face higher borrowing costs, slowing growth and job creation. The assumption of U.S. Treasuries as risk-free is shaken. Global investors may demand higher risk premiums, raising U.S. borrowing costs. The global financial architecture faces a stress test with potential for broader crisis. The financial conflict impacts ordinary lives, raising living and borrowing costs. Rising Treasury yields push mortgage rates higher, affecting homeownership. Adjustable-rate mortgage holders face increased payments, straining budgets. Retirement security is threatened as pension funds and savings lose value. Market volatility erodes confidence in long-term savings plans. The economic conflict fuels anxiety and uncertainty about the future. High tariffs raise consumer goods prices, acting as a tax on consumers. American farmers and manufacturers face income loss and business closures. Experts debate China's motivation behind selling U.S. Treasuries. Some see it as financial warfare, using economic power to gain leverage. Others argue against weaponization, citing mutual financial destruction risks. The U.S. Federal Reserve could intervene to stabilize the market. A nuanced view suggests market volatility isn't solely China's doing. Alternative theories point to hedge fund trades and margin calls. China's actions are seen as strategic diversification, not financial war. Letting bonds mature without reinvestment still impacts U.S. debt financing. The global financial system is at a critical juncture. Recent events expose vulnerabilities in the U.S.-China economic relationship. The future depends on policymakers' actions in Washington and Beijing. The U.S. faces challenges as cheap financing from China may end. Fiscal responsibility and new debt buyers become crucial. The world seeks to diversify reserves, moving toward a multipolar financial system. The transition may bring instability as new norms are established. Understanding these shifts is vital for shaping the global economic landscape.